Members of the scheme, ladies and gentlemen, welcome to the KenGen DC Scheme 2012 Annual General Meeting for the financial year ended 31st December 2021. I'm glad to announce that this year we have new members who have joined the scheme, and so our membership has indeed grown. We welcome you all into our DC family. We began the DC scheme journey with the sole mandate to ensure sustainable retirement benefits to our members and beneficiaries. We began by service 1634 members. We started with 1634 members who transferred their benefits from the DB scheme. Currently, we serve more than 2,300 members, which is a 41% growth in membership since the inception of the scheme. The scheme carries through what it set out to achieve many years back when it was formed, to growth and long-term performance. This is witnessed today, where the scheme total fund value stood at Kenya shillings 9.11 B, shy away from Kenya shillings 10 billion of assets, are a prime example of the work the board does to contribute to the sustainability of the scheme. This 10-year milestone is more potent and special as we delight of the past and celebrate the present growth, whereby we now not only internally administer the scheme, but we have also set up an income drawdown fund for our retiring members, which commenced operation from June 2022, which closed the month with more than 12 members drawing their regular income from the fund, confirming the confidence the members have with the scheme. The operating economic environment. According to the World Bank and IMF estimates, in the year 2021, Kenya's economy expanded at 5% and 5.9% respectively. The growth was witnessed in most sectors of the economy, spurred by the pickup of the COVID-19 vaccines and increase in government infrastructure projects. We expect a modest growth during this year due to the upcoming elections and the current turbulence in the international markets. We, however, trust our diversification strategy will offer a buffer to counter economic slowdown. Pensions regulatory environment. On the retirements regulatory front, there were amendments to the Regulation 19 through legal notice number 164 of 10th August 2021. Now, members leaving the scheme prior to attaining the specified earlier retirement age can only opt for payment of not more than 50% of their total accrued benefits. This is an amendment from the previous regulation whereby members could access 50% of employer contribution and 100% employee contribution together with accrued investment income. We, however, encourage members to continue accumulating their retirement package even with job movement, as this will come handy at the retirement age. Scheme investment overview. With approximately 9.11 billion Kenya shillings in net assets as of December 31st, 2021, scheme assets 12 months growth has been remarkable, an 18% increase, attributable to growth in contributions and investment. The investment primarily consists of long and short-term government securities, real estate, and private equity investments. The scheme was able to declare a net return of 10.4% growth compounded by performance across all the markets. Board of Trustees. In accordance with RBA Act and schemes regulations, schemes rules and regulations, the Board of Trustees is duly constituted. The names of the scheme, the name of the scheme trustees for reporting period are shown on page 10 of this annual report. Perspective of the scheme's future. The economic outlook in 2022 remains positive and is expected to expand at 4.5%, but at a slower rate than the previous year. We, however, remain cautious of the risks that include the conflict between Russia and Ukraine, rising fuel prices, the resurgence of new variants of COVID-19 virus, and the upcoming election period. Members, despite the uncertainties expected in the financial market, we are set to accomplish our goals and objectives. This we shall do by maintaining a balanced asset mix while constantly reviewing the same, in addition to considering other actions that can reduce risks and costs across the scheme. We remain committed to serving you members and ensuring the pension fund continues to pay promised pension benefits for this and generations to come. Appreciation.
In terms of GDP, this year we do expect there to be a much slower growth in terms of output. Remember, last year we were coming from a time after COVID, the growth went up to 7.5, which was quite high. Historically, if you go back even 10 years, it's going to be difficult to find such kind of a growth. So this year, the expectation is that the economy is going to grow about 4%, 4 to 5. And the reason for that is because we're starting now to go back to normal. As far as interest rates go, we'll start with inflation. Inflation being the measure of how fast the cost of living is going. This year, we are going to see a bit of a spike in that. And the main reason for this is, one, we've seen fuel prices have sustained to be quite high. Yesterday, we saw the government gave an advisory that they're going to continue supporting the fuel subsidy for longer than 1 year by an additional 16 billion. We've also seen food prices have been going up. I think some of the rain patterns have not been quite high. And the last report was that the inflation is at 7.9, which is higher than the central bank limit where they monitor at 7.5. So we do expect there to be a bit of a tightness in the pockets of people. And that also affects other things such as interest rates, which this year have been going up at the beginning of the year. We expect them to continue going up towards the end of the year. A good example is a one-year deposit, or even a 3-month deposit at the start of this year was at 9%. It is currently was at around 7%, and right now we're getting the same thing for around 9 to 10%. This has an impact on the bond portfolio because you do get to see some prices fall down, but we still continue to receive interest, and that means the performance from that part of the portfolio might be slightly lower than we're used to at 12, 13%. The other thing for equities, our expectation is that this year is going to be a bit tough. Remember, at the start of the year, we saw an issue with Russia, Ukraine. There's usually a knock-on effect. We call it butterfly effect, that comes from the fact that global economies are connected. We saw this during COVID practically, and with the Russia-Ukraine war, it has happened again, and especially on the oil side, which is one of the reasons our currency has been going up. So if you look at that, some of the companies have been affected. Our market itself has been affected by the fact that foreign investors have been pulling out money to take it back home. For a second reason, which is inflation is going up, not just in Kenya, but also in the developed economies. And what happens here is if the return back at home starts to increase, then they start taking money back home because there is no additional benefit for them to be looking out for returns out there. On the currency, we have seen it depreciate all the way to about 118. Things have been a bit tight on the dollar. If you want to buy big sums of dollar, you do not find them. So the banks are being quite limited, and the expectation is that it's going to be sustained there for quite some time. So I might have looked like I gave bad news all around, but it's not all bad. That's why we have the fund managers and your trustees as well. We work to find a way in between what is difficult.
We are the custodian of the DC scheme. So a custodian is simply a banker for the scheme. Our role is to make sure that those monies that are being mentioned are being kept well and safely. You had a presentation from my counterpart, Purity, from NCBA, who mentioned what the role of a custodian is, which is keeping those assets safe. Those monies you're hearing, 9-point-something billion that the fund managers manage, are held by the bank. So we make those investments based on what they advise us to do. So we transact those investments, whether it is buying, they advise us to buy, at the time to sell, they advise us to sell. So we do that on behalf of the scheme and on behalf of you members. That is why at the point where you are retiring, you find that the funds are still available, they are safe. That is a regulatory arrangement that is made like that so that we safeguard the assets of the members. So mine is very simple. I want to confirm to you that whatever assets have been reflected and audited, whatever assets were invested by the fund manager are the same assets we held. They are held safely and securely on your behalf. And so with that.
Thank you, Chair. All protocols observed. And on behalf of Deloitte and Touche, I want to confirm that we audited the financial statements and issued an opinion on 30th March 2021. I wish to further confirm that we have audited the accompanying financial statements of KenGen defined contribution. That's the DC scheme, as set out from pages 39 to 61, which comprise of the statement of net assets available for benefits as at 31st December 2021, and the statement of changes in the net assets available for benefits, and the statement of cash flows for the year ended, and a summary of significant accounting policies and explanatory notes. In our opinion, the accompanying financial statements give a true and fair view of the financial transactions of the scheme during the year ended 31st December 2021, and of the disposition at that date of its assets and liabilities, other than liabilities to pay retirement and other benefits falling due after the end of the year in accordance with the International Financial Reporting Standards and the requirements of the Kenyan Retirement Benefits Act. Thank you.
So as RBA, we are a state corporation formed by an act of parliament, and we are given 5 key mandates. And I will mention the mandates, the first one being to regulate and supervise the retirement benefit sector. So as we sit here today, I can confirm that KenGen DC Scheme and also KenGen DB Scheme are registered schemes, and they are registered by us. The service providers that have presented to you today are also licensed by us, including your internal administrator that was licensed recently, that is last year, end of last year. So the service providers are fit to run the scheme, and the trustees have also been trained. It's also our obligation and our mandate to protect the interest of members and the interest of the sponsor. So we are not only looking on one side, we look at both sides, the members and the sponsor. And one of the main interests for the members is on financial interest, because you have put in money and you expect in the next 20 years, 15 years, 5 years, 1 year when you retire, you expect that you will receive some retirement benefits. So it is our duty to ensure that indeed you receive those benefits as promised. And we also protect the rights of the sponsor. The sponsor has formed this scheme with an interest. Reputational risk is here. They want to see their members, they want to see their employees retire with dignity. That is an interest the sponsor has, and it is our mandate to protect that. We promote development of the industry. I've had the trust secretary and the trustees talk about the income drawdown fund. This came about in around 2012, but we have seen growth of these funds. It is an alternative to an annuity. As a member, you need to be aware of what it means to be in an income drawdown fund, what it means to be in an annuity. And I can confirm that the income drawdown fund for KenGen has been registered by the Retirement Benefits Authority. We also advise the cabinet secretary on matters pension, and we implement all policies relating to pension. So as a regulator, we sit at the top. We come up with regulations to govern the industry, because our vision is to see people retire with dignity. So we promote a platform to encourage and come up with new ways of ensuring that our retirees' needs are met. So that is why we also have the Post-Retirement Medical Fund. It's a product. I'm not so sure the scheme has implemented it. You have it? Yeah, because we realize that medical needs are one of the key needs that retirees have at retirement. And also housing is also one of the needs. We realize that we are having retirees building houses when they retire with their retirement money, and sometimes they have challenges here and there. So we came up with the mortgage regulations. They were there previously. What used to happen previously is you could use this, your retirement money or your retirement savings as a security to apply mortgage. So that was the second security. The first security was the house, then the second one will use the retirement benefits. But we realized that the uptake was slow. And in 2020, now there is a new law where you can actually access part of your benefits to build a residential house. Remember, this money you're saving for retirement. So as much as we want you to have a house, because even when you retire, you live in a house, we are also keen to ensure you also have an income in retirement. So there are some caveats to accessing this amount. And one of the caveats is you can only access up to 40%. You can only access while you are still in employment. Once you retire or reach retirement age, then you cannot use it for that particular purpose. You can only purchase a built home, so no off-plan, no purchase of land. It must be a residential house certified for occupation.
Yvonne, you have told us that we have, we can actually take 50% of our, what we have invested, but you did not talk about 50% of what our money has traded on, or maybe any percent, whatever it is, that's our money has, traded on. So basically now it's like it's coming back to just what we can, do on an ABC or do on a contribution. But why is it that the other side of investments somehow sounds to be a little bit silent?
What is the government, or what are you promising us? Simply the Wanjiku family in the next 6 months or 1 year also, simply because the common man is unable even to put the food on the table, bearing in mind that even Mogo has gone up. And when you see the likes of Ochoro, at times anasema kwamba saa zote yeye mgeni mheshima in the funerals and whatever and so on and so forth. We are also complied to take part in the society at home. So where is the common man?
DC scheme, the defined contribution scheme, is different from DB scheme. Just to refresh your mind. For the DB scheme, when you are retiring, there are parameters that we look at. One, your last salary. Two, your years of service. And three, a pension factor. So the issue of contribution. So what matters here most now is that last salary, years of service, and the pension factor. That's what determines your take home when you're exiting or retiring. But when it comes to DC scheme is solely on what you have contributed, what the employer has contributed, and return on investment. That is why you can see there is a lot of emphasis on our part as trustees on AVC also, additional voluntary contribution. Some of these retirees who are here have what is called the income replacement ratio going to up to 55%. What that means, the retirees, when they go home, their take home, their monthly pension is 55% of their last salary. Internationally, our target as a scheme is to try as much as if we can push it to 75 or 80%. But how do you achieve this? You can only achieve this if you are contributing well. That is for the employee. That is why myself and Serem come in also, that employees to get a good salary so that 20% that you are contributing is something reasonable. The employer is contributing for you. The 10% also, plus all that is 30%, plus return. So we encourage members, how do we improve our income replacement ratio from the average of 55? When I'm talking about 55, there are others who are even getting 20. There are those who are getting maybe 55, those who are earning higher salary, and those who also contributed very well, AVC, when they were still in employment. So I'm encouraging you, members, let us continue contributing to AVC. On the issue of return, that is how we come in as trustees. We oversight the work of the investment managers. It is the investment managers that invest this money, we get better return. We have a way of measuring their performance. On every 3 years, we renew their contract. If they do well, we continue with them. So we also already have an investment policy statement that guides them when they invest. So Waziri, that is where we are. And those return, the 50% you are talking about, you will only be entitled to that 50% the moment you exit KenGen before you attain your retirement age. But the retirement, in our case, we are still in employment, but want to leave earlier, you will only be given 50% of your contribution. The return that you're talking about, the moment now you attain the retirement age, you will be given all that in lump sum. So, and RBA is also listening very well. You don't lose even a single cent of what you are entitled to. That's just an assurance I want to give you. Job, the issue of uchumi ni mbaya, mafuta imepanda bei, ikifika DC, we can't help. I must be blunt and tell you the truth. For the DC scheme, ile pesa, even the income drawdown that you'll continue getting there will be no increment. What matters is how we are investing your money. Like now, I was telling you, we are getting 13%. If we are giving you 13% on what you've kept with us, then that is the money you'll be getting 13% every year on top of what you've left with us. And it is now upon you to tell us, how will you want to be getting this money? Do you want 10% of that alone, so that your principal amount and the other 2% continue loading? So it is upon you. So Bob, Job, we can't help much. It is only that we'll continue pushing our service providers to invest our money in asset classes that give us good return.
The next question was from Not a question really, it's from a comment from Antonio Mondi and Nixon Dunge. This is majorly on mortgage regulations, a lot of interest on it. What I would wish to confirm, the regulations are there now. You just need a phone call to the scheme, drop an email to the scheme. We'll be able to give you the guidance and the regulations, how you are able to access and the procedure expected. The next question was from Caston Mwangi. It's majorly a demonstration on how to access your benefit. If you have 10 million today, how much will be paid? How is the taxation? My team is handling that because it's require a specific answer. The next question was a comment from Michael Okello. Just a confirmation that the two initiatives by the scheme that is on AVC and the mortgage regulations are great for the youth, and he's looking forward to guidance on how to do the same or to access his benefits for a mortgage, and also how to increase his additional voluntary contributions, and my team will also guide him. The last one is from Endangaho, thanking for the education. Is there anything to lose if one takes 50% before retirement? As the chair has confirmed, you can only access 50% if you leave employment of KenGen.
Maybe just to emphasize on the issue of the mortgage, it's already there, it's up and running. Anybody who is interested, any member here, you can access it. But our advice also as trustees to you is that you access or you get that particular facility. The implication is that your take home when you are retiring will be reduced. And if, in fact, let me put it this way. Currently, the sponsor KenGen has that facility, the mortgage. So we are encouraging you members that let us utilize that mortgage facility with the employer, because you'll use your salary to pay. And the interest is very low, very, very, very low. As opposed to, I know these are products that are there, RBA said yes, we should allow you, but we also need to tell you the other side of it, that if you're in employment, why can't you use your salary and take that mortgage facility instead of you getting 40% of your benefit now, and the moment you retire, you'll be leading a poor life. And that is why you can see now some of our members are also complaining, those who have retired. And I'm sure they will advise you, if it is possible, don't touch your retirement, anything, even a single cent when you're still working. It's not a surprise that you're asking that question. We've had it many times. And the answer to this is this. According to the Retirement Benefit Authority Act, your contribution, employer contribution, return on investment, when you are exiting, we are not supposed to touch even a single cent. And doesn't matter whether you have a car loan, whether you have a mortgage loan, whether you have a guaranteed anybody in Stima Circle, we are obliged as trustees to pay you what you are entitled to. Ni sawa sawa? That is, hiyo ndio sheria. But as a member, when we are paying you and you decide that part of this money, you will want maybe 10%, 20% to go to Stima Circle, you will want to pay the employer, the liability to the employer if you have a car loan, that we can do. We can pay you less that amount, as long as you put it in writing. Annual general meeting report, its proposals, recommendations, and presentations made by various stakeholders be adopted and form part of this particular meeting. Can I get a proposer, please, and a seconder?
Mustafa Hussein Abdi proposes.
Thank you very much, Abdi. It's proposed. Seconder?
Tiberius Onsongo, I second.
Tiberius Onsongo as seconded. Thank you very much. As we conclude the AGM, I want to say asante sana to the main organizers of this event, that is the Secretariat. You did well yet again to ensure that nothing but success of this AGM. To our members watching from various areas and those with us here, we could not have had this AGM without you. It is because of you that we are here. Thank you, Western Region, led by Engineer Abiero, for your hospitality. And finally, to my fellow board members, your support is highly appreciated. Thank you so much.